Hi everyone, welcome back to the channel. In this video, we'll be going over how you can go about building a globally diversified, low-cost, tax-efficient portfolio using ETFs. So I'm going to give 3 sample portfolios that you could possibly refer to when you're actually going about this process of building an ETF portfolio. First sample portfolio is going to consist of BWRA and IGLA. This is an accumulating portfolio that follows a globally diversified strategy. The second sample that I'm going to be talking about is the same strategy, but it follows a distributing approach. And the third sample portfolio that we're going to be discussing has more than 2 ETFs, but the advantage of this strategy is that you can decide if you want to have a higher weightage towards any particular geography, and that is completely discretionary. That means it's up to you as to how you want to structure your own portfolio. So we'll be going through fact sheets for BWRA and IGLA, the first sample portfolio. I wanted to go through the fact sheets to explain what I would look for when I'm building a passive portfolio, what are the factors that I think are important, and how having a Ireland domicile portfolio is going to be more beneficial for non-Americans due to tax purposes. Now, the reason I'm going to be speaking specifically for non-Americans is due to the fact that non-Americans and Americans are taxed very differently when it comes to certain ETFs. So here we have the first fact sheet, which is BWRA. This is provided by Vanguard, as you can see right on top. It is the Vanguard FTSE All World ETF. And let's go through the main objectives before anything else. So the fund employs a passive management or indexing investment approach through physical acquisition of securities and seeks to track the performance of the FTSE All World Index. The index is comprised of large and mid-sized company stocks in developed and emerging markets. So this being a globally diversified strategy, you get exposure to both developed and emerging markets. Now, this particular ETF, the currency for this ETF is USD. If you're looking to buy the same ETF in, say, pounds, you could use the ticker BWRP to buy the same ETF. If you're looking to buy the same ETF in euros, you could use VWCE. So the first thing that I actually want to focus on is looking at the fund size. So this particular ETF, as of 30th June, had 983 million in assets. The total assets held by this particular globally diversified ETF is 5.5 billion. So the next factor we can look at in this fact sheet is the fact that the charges for this particular ETF are at 0.22% annually. What this translates to is that for every $10,000 invested in this ETF, you pay $22 annually. So you can see this graph here that shows the impact of fees. You could pause here and actually look at the values by showing how much even a small increase in the fee results in a huge change in the final value of your investment. The next, and probably the most important factor that we're looking at here, is the fact that the domicile is in Ireland. Now, you may be wondering as to how a Ireland domicile makes a difference. So Ireland and the United States have a double tax agreement, which is a huge benefit to non-Americans in the fact that they don't have to pay estate taxes. Also, if an ETF is distributing its dividend income, it is taxed at a lower rate if the domicile is in Ireland. This is to the benefit of non-Americans investing in an all-world globally diversified ETF. If you aren't sure what exactly estate taxes are, I have another video that I've put up earlier. You could refer to that, and that clearly explains what estate taxes are and how they could impact you as a non-American. So the next thing that you'd want to look at are the top 10 holdings of this particular ETF. As you can see, we have them here: Microsoft, Apple, Amazon, Alphabet, Facebook, Alibaba, Johnson & Johnson, Tencent, Berkshire Hathaway, and Visa. As we can see, just from the top 10 holdings, it's highly weighted towards the American market and specifically towards technology. But if you actually look at the weighted exposure, Technology is only 20% of the entire weightage of the ETF. It's a relatively balanced ETF. The fact is that technology has been outperforming the rest of the market over the past 10 years. Hence, the weightage in technology is a lot higher. You could see that this fund holds 3,473 stocks in the ETF. What this implies is that there's less risk of a single company having an impact on your portfolio because you're so diversified across a broad range of industries and geographies that one stock doing badly or doing well does not affect your portfolio so much. It has to impact the market as a whole for your portfolio to be effective. If you're interested in learning about the other characteristics, the glossary for ETF attributes gives you an idea about the characteristics. You can read into this and that will help you understand the ETF better. So this covers the equity portion of a 2 ETF globally diversified portfolio. Now let's look at the bonds. When it comes to bonds in your 2 ETF portfolio, you want them to be stable. That's why we look at global government bonds. The provider here is BlackRock. The ETF is IGLA. The goal of having bonds in the portfolio is to provide stability to your overall portfolio. We're going to be looking at the key facts that are included in this ETS fact sheet. The first thing that we'll be looking for is the fact that the expense ratio is also very low, same as BWRA. It's at 0.2%, which means that for every $10,000 invested, $20 other fees charged annually. Since it is an accumulating ETF, there is no distribution of interest. The domicile is in Ireland, which again avoids estate tax. Going through the geographic breakdown, we can see that the ETF is highly weighted towards the United States, Japan, France, Italy, Germany, United Kingdom. ETF is highly focused on stable government bonds, and due to the United States being the largest economy, it's more so weighted towards the United States. Looking at the portfolio characteristics, we can see the weighted average maturity is 10.46 years, and the weighted average coupon is 1.94, weighted average yield to maturity is 0.13%, the effective duration is 8.75 years. If you want to know more about the portfolio characteristics, you could scroll down to the glossary right below and read about each of those. So there you have the first sample covered of a globally diversified ETF portfolio. Now, deciding the allocation of how much you want to have in equities versus how much you want to have in bonds, that's a very personal decision. You'd want to look at how risk averse or risk seeking you are as an investor. If you want to have a more of a stable portfolio, you could have a higher allocation into bonds and a lower allocation into equities. Whereas if your time horizon is very long, say 15 years or 20 years, you could have a higher allocation into equities and a lower allocation to bonds. Now, the second portfolio that we have as a sample is the exact same portfolio as the first. The only difference is the fact that it is a distributing portfolio. What this means is that every 3 months, the ETFs will provide you with dividend income from the equities and interest income from the government bonds, and you will see this money accumulate in your brokerage account. The downside to this portfolio is that it is less tax efficient compared to the first one, as you will have to pay 15% tax on the dividends that are received, as opposed to in the first sample portfolio where there is no dividend tax. Due to the structure of the portfolio, it is an accumulating portfolio, and also both samples do not have any estate taxes due to their Ireland domicile and being listed on the London Stock Exchange. The third portfolio sample of having globally diversified ETFs include VUSD for US stocks, ISFD for UK stocks, ISEU for European Union stocks, VDJP for Japanese stocks, EIMI to cover emerging markets as a whole. That's the equity portion. Looking at the bonds, you can have IGLO, which are government bonds, LQDE, which includes investment grade corporate bonds, IEMB, which includes emerging market bonds. So the advantage of the third sample portfolio is the fact that it gives you more flexibility. So if you are more bullish on, say, emerging market equities, you can have a higher weighting in EIMI as opposed to any of the other ETFs. That is a personal choice. That is up to you. Deciding the portfolio allocation is completely subjective. I hope this video has given you a better idea as to how you could possibly go about building a globally diversified ETF portfolio. There's a link below in the description that you could use as a guide to figure out what the tax implications would be for you specifically based on your residency. Also, if you've got further questions with regards to how to build the portfolio, you could leave questions in the comments below. I hope you found this video informative, and if it did, please do hit like, hit subscribe. That helps out the channel. And thank you for watching.